Nowadays, we don't need to spend time trying to find the best dividend stocks to invest in, because there are many dividend ETFs which include hundreds and even thousands of dividend-paying stocks. Okay, so the first fund on my list is the S&P UK Dividend Aristocrats ETF, ticker symbol UKDV. This ETF was launched in 2012, which means it has a track record of over 10 years, a reassuring factor for potential investors evaluating its performance and stability over time. The objective of the fund is to track the performance of a group of high dividend paying stocks from within the UK that are part of the S&P UK High Yield Dividend Aristocrats Index. In case you're not familiar with the term, dividend aristocrats are those companies which have paid their dividends consistently and increased them as well for at least the past 25 years. The top 10 holdings include companies like IG Group, Intermediate Capital Group, Primary Health Properties, and so on. In total, this fund includes 35 high dividend paying stocks, many of which are reliable UK companies that are known for consistently paying their dividends and increasing them year after year. This is ideal for dividend investors because you have confidence that you'll always get your income from them. These companies are all weighted according to the size of their dividend, meaning that the companies with the highest yield get a larger allocation. Moving on, this ETF pays a dividend of 3.65% at the time of this video, distributed semi-annually. It's quite a good dividend yield, but you need to factor in that you will only be paid a couple of times per year and not every quarter, as is typically the case with most dividend ETFs. Now, in terms of fees, which is one of the most important things to look at, we can see that the annual charge to invest in this ETF is 0.30%, but it also has transaction fees of 0.22% per year. So overall, it would cost 0.52% to invest in it, which is definitely more than what you're going to see with a traditional index fund. But that's normally the case with these dividend ETFs, and there are certainly more expensive funds out there. With regards to its past performance, this fund is actually down about 7% in the past 5 years. It's really not that much of a surprise, especially when we consider the different market conditions that we've been experiencing in the past few years. One more thing I want to mention is that this fund is much smaller than some other ones that we'll be looking at, with only about 110 million pounds under management. The reason I'm mentioning this is that in some cases, if the fund doesn't attract many investors, the fund manager may choose to close it. Just something to keep in mind. The next ETF on my list is the S&P Global Dividend Aristocrats ETF, ticker symbol GBDV, which aims to track the performance of high dividend paying stocks globally. So it focuses on dividend aristocrat stocks from all over the world that are known for paying consistent dividend income going back many years. This ETF was launched in 2013, giving us a decade worth of data that we can look back on and compare it with similar ETFs. And with regards to its size, it's quite a large fund with almost £1 billion invested in it, which means that it's quite popular with investors and the risk of closure is very, very low. Looking at its geographical breakdown, we can see that it's concentrated in the US market, with almost 48% allocated there, followed by Canada, Asia, the Eurozone, UK, and so on. So bear this in mind that although it's labeled as global, it's concentrated in the US, which isn't really surprising given that it's the biggest stock market in the world, but it's nonetheless something to bear in mind. Also, in terms of market classification, the fund invests in dividend stocks from both developed and emerging markets, but clearly the bulk of its investments is in the developed markets. This is really what you want from a dividend fund, because emerging markets are very volatile, and when it comes to dividend income, you want stability. The top 10 holdings include mainly American companies like Universal Corporation, which is a tobacco company, Verizon, H&I, and so on. We also have Adecco, which is a Swiss stock, Lenovo in China, etc. Overall, the fund invests in 93 stocks from different countries around the world. Similarly to the previous fund, all these companies are weighted according to the size of their dividend, meaning that the highest dividend payer gets the top spot and the fund is regularly adjusted accordingly. Moving on, in terms of dividend yield, this ETF pays a nice dividend of 4.17% at the time of this video, but unlike the previous fund, it's paid on a quarterly basis, meaning that you get 1.04% every quarter. So if you're looking for frequent dividend income, this fund ticks that box. However, the ongoing charge of this ETF is 0.45% per year, and the transaction costs are an extra 0.11%. So all in all, you would be charged 0.56% per year, which is something to consider. It's quite expensive in my opinion, especially when compared to the next ETF that we'll be looking at, which is also a global one. Now, with regards to its past performance, the fund is down 2.8% in the past 5 years. Nothing serious, but it did manage to continue paying a good dividend year after year. To put this into perspective, $10,000 invested in this ETF 5 years ago is now worth $9,720, assuming the dividends weren't reinvested. The reason I'm I'm using dollars is because that's the fund's base currency. This means that as UK investors, we are exposed to currency risk because every time we get paid a dividend, it needs to be converted into pounds. That's the case with most global funds, and there isn't much we can do about it. Another thing that you need to be aware of that applies to us UK investors is the dividend withholding tax that we get charged for being paid the dividend from overseas stocks. Unfortunately, stocks and shares ISA do not have any special status for foreign tax, meaning that foreign stocks in an ISA get treated exactly the same as foreign stocks outside an ISA. So for example, for dividend stocks in the US, you will be charged a dividend withholding tax of 15%, but other countries charge different percentages. Now you don't see that anywhere because any dividends paid to you would have already been taxed before they reach you. It's worth being aware of, but again, there is nothing we can do about it. Before we get into the next fund, do me a huge favor and hit that subscribe button if you're getting any value from this video. It really does help small channels like mine. Thank you. The third fund on my list is one of the most well-known dividend-paying funds, Vanguard FTSE All-World High Dividend Yield ETF, ticker symbol VHYL. This is another global dividend fund which invests in large and mid-sized companies in developed and emerging markets that pay dividends that are generally higher than average. This fund was opened in 2013 and is clearly very popular with investors as it has almost £3.7 billion invested in it. If we take a look at the geographical breakdown, we can see that unexpectedly the US is going to dominate, with 42% allocated there, followed by the Eurozone with 11%, then Japan with 8% and so on. And in terms of market classification, 91% of the stocks are from developed markets and only 9% from emerging markets, which will ensure we get a relatively stable dividend income. Of course, those stocks in emerging markets can give it more growth, but it will come with more volatility. With regards to its top 10 holdings, most of them are American companies, such as JP Morgan, Exxon, J&J, P&G and so on. Huge companies that are known for paying good dividends. In fact, Exxon and P&G are known as dividend kings, which are companies that have paid consistent dividends for the past 50 years. Really impressive. This is a much bigger fund than the previous global one that we looked at. It includes over 1,800 dividend paying stocks from all over the world. So it's certainly much more diversified than other global funds out there. In terms of dividend yield, the fund pays 3.31% per year in dividends and is distributed every quarter. In other words, for every £100 invested, you will get paid £3.3 per year. It's not the highest yield that you will come across, but this fund has actually performed much better than the previous two ETFs, growing by 22% in the past 5 years, or 4.4% per year on average. If we add the dividend yield to this, it's returned an average of 7.7% per year in total, which is fantastic. Also, the beauty of this fund is that it costs only 0.29% per year to invest in it, and it has a very small transaction fee of 0.06%. Overall, its total fee of 0.35% per year falls in line with Vanguard's typical low-cost structure. So it's much cheaper than the previous two funds that we looked at, it has performed better, and it pays a really good dividend. Plus, it's much more diversified. This is probably the best dividend fund on my list, to be honest. Now, going back to the UK, the next one is the iShares UK Dividend ETF, or IUKD, which is very similar to the first ETF that we analyzed. This fund's objective is to track the performance of an index composed of 50 UK listed stocks with leading dividend yields, excluding investment trusts. This is a very long-standing fund, which was launched almost 20 years ago, and it's got more than £800 million invested in it, which again gives us some indication that it's quite a popular choice for many investors. Its top 10 holdings include household names such as Rio Tinto, HSBC, British American Tobacco, and so on. A lot of tobacco companies and banks, basically. And overall, it tracks 51 of some of the best UK dividend stocks. Generally, all these funds that are focused on the UK market are very similar in terms of composition. The main difference is that they're managed by a different company. So they're trying to achieve the same result but in different ways, which is why their fees will be different from one another. Of course, one of the most important factors when it comes to dividend funds is how much dividend income we might expect from our investment. So in that regard, this fund has a very handsome dividend yield of 5.34% per year and is paid quarterly, which is a plus. I think this is the highest yield of all the funds that we've analyzed so far. However, this higher dividend yield comes with a trade-off, as this fund has an annual cost of 0.43% per year. year, and the transaction fees are an extra 0.35% for a total of 0.78%. So these are some very high fees overall, and certainly one of the most expensive UK-focused ETFs that we looked at. In terms of capital growth, the fund is down over 10% in the past 5 years, and negative 2% per year on average. Again, not a big surprise here given the recent economic environment. However, it does pay a good dividend, so assuming it was reinvested, it has a total return of 3% per year on average. All in all, I think this is a good income producing fund for those seeking passive income, but it's quite expensive in my opinion, and the capital returns are pretty much non-existent. Moving on, the next ETF on my list is the Wisdom Tree Global Quality Dividend Growth ETF, or GGRP. This is quite an interesting fund because it invests in dividend-paying stocks from developed markets, but which also have growth characteristics. The ETF was launched in 2016, so it's not as old as some of the previous ones, but it does have over $1 billion invested in it, so it's clearly quite popular. Its base currency is the dollar, so again, as UK investors, we will be affected by the exchange rate between the pound and the dollar. Looking at its geographical breakdown, it's heavily weighted to the US, followed by Europe, UK, Japan, etc. The top 10 holdings represent 26% of the entire fund, and include names such as Microsoft, Apple, Coca-Cola, Johnson & Johnson, and so on. These are all stocks which are known for paying a good dividend while also growing in value. Overall, the fund invests in almost 600 stocks from all over the world. And it's interesting to see the sector breakdown as well, with healthcare and IT dominating, then followed by consumer staples, industrials, and so on. This highlights that the quality criteria that Wisdom Tree has used leads to companies in growth sectors being selected. Now, this fund has a dividend yield of only 2.23% and is distributed semi-annually, as you can see from the distribution history here. It's not the highest yield out there, and if you're looking for more regular income, the distribution frequency might not be ideal. However, in terms of past performance, the fund is up by 65% over the past 5 years, or a 13% return per year on average, which is a fantastic return. When compared to VHYL, the performance difference is significant, with GGRP growing 3 times more than the Vanguard fund. So, although GGRP pays a lower dividend yield than VHYL, the capital returns are much higher. And in terms of fees, this ETF costs 0.38% per year, which unlike a traditional fund is quite high, but lower than many other dividend funds. All in all, I think that this is a decent dividend ETF that definitely deserves more attention. Before I share the last fund on my list, I just wanted to make it clear that I'm not recommending you invest in any of these funds. I am not a financial advisor and nothing in this video represents financial advice. It's just meant to help you with your own research. The last fund on my list I wanted to mention quickly is one that many people forget about when considering dividend ETFs, the Vanguard FTSE 100 ETF, or VUKE. This fund is not labeled as a dividend ETF, but due to the nature of UK companies, which are great dividend payers, it pays a handsome dividend yield, as you will see in a minute. Its top 10 holdings include household British names such as Shell, AstraZeneca, HSBC, Unilever, etc. And overall, it includes the top 100 UK businesses. However, unlike some of the other UK-focused dividend funds, these stocks are weighted according to their market cap, not their dividend yield. This means that the bigger the company, the bigger their share of the fund. In terms of dividends, this ETF has a very good dividend yield of 3.82% per year, which is distributed quarterly. But the main thing with this fund is that it's extremely cheap, with an ongoing charge of only 0.09% per year, and a small transaction fee of 0.05%. Therefore, it pays a very good dividend and for a very low fee, which is ideal. However, as expected, its capital returns aren't that great, returning only 9% in the past 5 years, or approximately 1.8% per year. But when we compare it to the other UK-centered dividend funds, it's actually outperformed while paying a high dividend. In terms of where to buy these ETFs, I've added the different investment platforms that sell them to this table, so that you can check them out in your own time. Now, there are a few things to keep in mind when investing in dividend ETFs. First of all, it's worth noting that dividend yields will always fluctuate, because not all companies pay constant dividends, and some may even stop paying dividends altogether. Also, most of these funds are much more expensive than a traditional passive tracker, and over the long term, fees do add up, which is why you need to be very clear about your investment strategy. If passive income is your main objective, make sure you choose a fund that is worth the fees. But if you're looking to grow your portfolio, you may want to consider a very cheap traditional market cap weighted index fund. So watch this video next to find out my top Vanguard funds for 2024 and beyond.